What if I told you that one of the world's most successful investors predicted the 2008 financial crisis years before it happened, and then wrote a blueprint for preventing the next economic catastrophe? Today, we're diving deep into George Soros' explosive 2012 book Financial Turmoil in Europe and the United States, a work that reads like a financial thriller but contains real-world solutions that could have saved trillions of dollars and millions of jobs. This isn't just another dry economics textbook. This is the insider's guide to understanding how global financial systems actually work, written by someone who made billions by betting against broken systems and who now reveals exactly how to fix them. Soros didn't just observe the 2008 crisis from the sidelines. He was actively shorting markets, making strategic moves, and watching his theories play out in real time as banks collapsed and economies crumbled. But he's what makes this book absolutely fascinating. Instead of just celebrating his successful predictions, Soros uses his unique position to offer concrete solutions for preventing future disasters. He combines decades of market experience with deep philosophical insights about human nature and economic behaviour. The result is a book that simultaneously explains why financial crises happen and provides a roadmap for building more stable economic systems. What sets this work apart from typical financial literature is Soros' willingness to challenge conventional wisdom. He doesn't just critique failed policies, he proposes radical alternatives that could fundamentally reshape how we think about money, markets, and international cooperation. This book summary will reveal the key insights that make this one of the most important financial texts of the 21st century. George Soros published Financial Turmoil in Europe and the United States during one of the most precarious periods in modern economic history. The European debt crisis was reaching fever pitch, with Greece teetering on the brink of default and contagion threatening to spread across the continent. Meanwhile, the United States was still grappling with the aftermath of the 2008 financial meltdown, struggling with high unemployment and political gridlock over fiscal policy. Soros brings a unique perspective to this analysis. As founder of Quantum Fund and one of history's most successful hedge fund managers, he possesses an insider's understanding of market dynamics that few authors can match. His track record speaks for itself. He famously earned over $1 billion in a single day by betting against the British pound in 1992, an event that became known as Black Wednesday. But Soros is far more than just a successful trader. He holds a philosophy degree from the London School of Economics and has spent decades developing his theory of reflexivity, which explains how human perceptions shape market realities in ways that traditional economic models fail to capture. The timing of this book's publication was crucial. Written as Europe faced its most severe crisis since World War II, and America continued wrestling with the consequences of financial deregulation, Soros offers both historical perspective and forward-looking solutions. He doesn't merely diagnose problems, he prescribes specific remedies based on decades of market experience and philosophical reflection. What makes this work particularly compelling is Soros' dual role as both market participant and social theorist. He has profited enormously from market inefficiencies while simultaneously advocating for reforms that would eliminate many of those same profitable opportunities. This apparent contradiction reveals the depth of his commitment to systemic stability over personal gain. The book represents his attempt to share hard-won insights about market behaviour and policy solutions with a broader audience during a critical moment in global economic history. Financial Turmoil in Europe and the United States presents Soros' comprehensive analysis of the interconnected crises that shook global markets in the late 2000s and early 2010s. The book is structured around his central thesis that these crises were not random events but predictable consequences of flawed economic theories and misguided policies. Soros argues that mainstream economic thinking, particularly the efficient market hypothesis, fundamentally misunderstands how financial markets actually operate. The work begins by examining the roots of the 2008 American financial crisis, which Soros traces to decades of deregulation and the dangerous expansion of complex financial instruments. He explains how the housing bubble was inflated by perverse incentives throughout the financial system, from mortgage brokers who earned commissions regardless of loan quality to rating agencies that were paid by the very institutions whose products they have evaluated. Soros then shifts focus to the European crisis, arguing that the Eurozone's structural design contained fatal flaws from its inception. He demonstrates how the common currency created unsustainable imbalances between member nations, with Germany accumulating massive surpluses, while peripheral countries like Greece, Spain, and Portugal ran dangerous deficits. The lack of fiscal integration meant the crisis-hit countries couldn't devalue their currencies or rely on meaningful federal support, creating a deflationary spiral that threatened the entire project. Throughout the analysis, Soros weaves in his theory of reflexivity, which holds that market participants' perceptions and actions can fundamentally alter the underlying reality they're trying to understand. This creates feedback loops that can drive markets far from equilibrium, making traditional economic models largely irrelevant during crisis periods. He uses this framework to explain why both the American housing bubble and European sovereign debt crisis developed such destructive momentum once they began unfolding. The book identifies several pivotal moments and underlying dynamics that shaped both the American and European financial crises. Soros begins with the deregulation movement that gained momentum in the 1980s under Ronald Reagan and continued through subsequent administrations. The repeal of the Glass-Steagall Act in 1999 emerges as particularly significant as it allowed commercial banks to engage in investment banking activities, dramatically increasing systemic risk. This deregulation created an environment where financial institutions could pursue increasingly speculative strategies while enjoying implicit government guarantees. The development of complex financial instruments represents another crucial factor in Soros's analysis. He details how mortgage-backed securities and collateralized debt obligations allowed banks to package and sell risky loans to investors worldwide, spreading toxic assets throughout the global financial system. The rating agencies played a destructive role by giving these instruments A-to-A ratings despite their inherent risks, creating false confidence that enabled massive overinvestment in housing-related assets. Soros identifies the Federal Reserve's monetary policy as a key driver of the housing bubble. Alan Greenspan's decision to keep interest rates artificially low for extended periods encouraged excessive borrowing and speculation. When the Fed finally began raising rates, it triggered the collapse of the housing market and exposed the dangerous leverage that had built up throughout the system. The resulting credit crunch spread rapidly as banks lost confidence in each other's solvency. The European crisis receives equally detailed treatment, with Soros highlighting the fundamental contradictions built into the Eurozone's design. The Maastricht Treaty created a monetary union without corresponding fiscal integration, leaving member countries vulnerable to speculative attacks once their debt sustainability came into question. Germany's insistence on austerity measures for crisis-hit countries created a deflationary dynamic that made debt burdens even more unsustainable. The Greek debt crisis serves as Soros's primary case study for European dysfunction. He traces how Greece's fiscal problems, while serious, were manageable until they became the focus of speculative attacks. The European Central Bank's initial reluctance to act as lender of last resort created a self-fulfilling prophecy as borrowing costs soared and the crisis spread to other peripheral countries. The bailout programs imposed harsh austerity conditions that deepened recessions and increased debt-to-GDP ratios. Soros also examines the political dynamics that complicated crisis response in both regions. In the United States, partisan polarization prevented effective fiscal stimulus and led to dangerous debt-ceiling standoffs that spooked global markets. European politics proved even more problematic as decisions required consensus among multiple sovereign nations with divergent interests and political constraints. The interconnectedness of global financial markets meant that problems in one region quickly spread to others. European banks had significant exposure to American mortgage securities, while American financial institutions were heavily invested in European sovereign debt. This created feedback loops that amplified the crisis and made coordinated international response essential yet politically difficult to achieve. Throughout his analysis, Soros emphasizes how conventional economic wisdom failed to anticipate or adequately respond to these developments. Policymakers trained in efficient market theory were unprepared for the self-reinforcing dynamics that drove markets away from equilibrium and created systemic instability. The first crucial lesson from Soros's analysis is that financial markets are inherently unstable and prone to boom-bust cycles that can cause enormous economic damage. Traditional economic theory's assumption that markets naturally tend toward equilibrium is fundamentally flawed. Instead, markets are driven by reflexive processes where participants' perceptions and actions continuously reshape the underlying reality. This means that bubbles and crashes are not anomalies but inevitable features of unregulated financial systems. Understanding reflexivity provides investors and policymakers with a powerful analytical framework. When market sentiment becomes detached from underlying fundamentals, it creates opportunities for contrarian investors while simultaneously building systemic risks. Soros demonstrates how recognizing these patterns allowed him to profit from major market dislocations, while advocating for policies that would reduce their frequency and severity. The book reveals how regulatory capture corrupts the policy-making process and enables dangerous risk-taking by financial institutions. When regulators come from and return to the industries they're supposed to oversee, they develop sympathies that prevent effective oversight. This dynamic was clearly visible in the years leading up to 2008, as banking regulators consistently sided with industry arguments against stronger capital requirements and restrictions on complex financial instruments. Soros's analysis highlights the critical importance of international coordination during financial crises. Modern economies are so interconnected that problems in one region quickly spread globally, making unilateral responses inadequate. However, political systems are still organised around national interests, creating dangerous coordination failures. The European crisis exemplifies this problem, as national governments pursued policies that made collective problems worse. The author demonstrates how austerity policies during recessions create self-defeating dynamics that worsen both economic performance and fiscal positions. When governments cut spending during downturns, they reduce aggregate demand and tax revenues while increasing unemployment and social costs. This lesson has profound implications for current policy debates about appropriate responses to economic crises. Another vital insight concerns the role of central banks as lenders of last resort. Soros shows how the European Central Bank's initial hesitation to backstop sovereign debt markets created unnecessary instability and economic damage. Central banks must be willing to act decisively to prevent liquidity crises from becoming solvency crises, even when this requires taking on political risks. The book illustrates how income inequality contributed to both the American housing bubble and European peripheral country deficits. When wages stagnate while productivity grows, consumption can only be maintained through increased borrowing. This creates unsustainable debt dynamics that eventually trigger financial crises. Addressing inequality is therefore not just a social issue, but an economic stability imperative. Soros emphasizes that financial innovation without corresponding regulatory oversight creates systemic risks that can threaten entire economies. Complex instruments like derivatives can provide genuine economic benefits by allowing risk to be distributed more efficiently, but they can also obscure risks and create dangerous interconnections between institutions. Regulators must stay ahead of financial innovation to prevent new instruments from destabilizing the system. The author's analysis reveals how political polarization hampers effective crisis response and creates additional economic uncertainties. When political systems become gridlocked, markets lose confidence in governments' ability to address problems, potentially triggering additional instability. This suggests that political reforms may be necessary complements to financial regulatory changes. Finally, Soros argues that successful crisis management requires leaders who understand both market dynamics and political realities. Technical expertise alone is insufficient. Policymakers must also possess the political skills necessary to build coalitions for necessary but potentially unpopular reforms. This combination of analytical ability and political acumen is rare but essential for navigating complex financial crises. George Soros' Financial Turmoil in Europe and the United States stands as one of the most important financial texts of our time because it successfully bridges the gap between theoretical understanding and practical application. Written by someone who has both profited from market inefficiencies and advocated for systemic reforms, the book offers unique insights that remain highly relevant more than a decade after its publication. The work's enduring value lies in its demonstration that financial crises are not acts of nature, but predictable consequences of specific policy choices and institutional arrangements. Soros's theory of reflexivity provides a powerful framework for understanding why markets deviate from equilibrium and how these deviations can become self-reinforcing. This understanding is essential for anyone seeking to navigate financial markets or design more stable economic systems. Perhaps most importantly, the book serves as a call to action for both policymakers and citizens. Soros argues convincingly that the risks he identified have not been adequately addressed, meaning future crises are virtually inevitable unless significant reforms are implemented. His specific policy recommendations, from banking regulation to Eurozone governance, provide a roadmap for building more resilient financial systems. The book's combination of rigorous analysis and accessible writing makes complex economic concepts understandable to general readers while providing sufficient depth to inform specialist audiences. Soros' willingness to challenge conventional wisdom and propose radical solutions makes this essential reading for anyone seeking to understand how modern economies actually function and how they might be improved. In an era of continued financial instability and growing inequality, these insights remain as relevant and urgent as ever.